Hello friends, I welcome you my YouTube channel. I am Dr. Sharanu Chikkalli, Assistant Professor of Commerce, Government First Aid College, Kamlapur District, Kalburgi. Dear friends, we have seen in previous videos of ratio analysis part 2 and part 3 about liquidity ratios and activity ratios. In this video, I am going to discuss another kind of ratios, that is profitability ratios. And here profitability ratios in relation to sales are discussing, and other ratios relating to capital and investment will be discussing in the next video. I request all of you to like this video and subscribe my YouTube channel for further commerce and management related videos. Now let us see into the profitability ratios. As we know, every business object is to earn profit, and it should earn sufficient amount of profit to survive and grow over a long period of time. In fact, the efficiency of business is measured in terms of profit. Here, profit refers to the absolute quantum of profit or net profit figure as exhibited in profit and loss account. And even stakeholders of the firm are very much interested to know the performance of the firm in terms of profit. Like investor want an adequate return on their investment, creditor want high security for their interest and loan, and workers want higher wages. To know the profit, the firm prepares profit and loss account or statement of profit and loss, but this statement gives profit figure in absolute terms, doesn't convey the proper meaning. Therefore, profitability ratios are calculated to analyze the earning capacity of the business, which is the outcome of utilization of resources employed in the business. Here, profitability refers the earning capacity of the firm, and it is measured in relation to sales and in relation to investment. Profitability in relation to sales indicates the amount of profit per rupee of sales. Similarly, profitability in relation to investment indicates the amount of profit per rupee invested in assets. These profitability ratios are expressed always in terms of percentage. Let us see the first profitability ratio, that is gross profit ratio. This is the ratio of gross profit to net sales and expressed as a percentage. It reveals the amount of gross profit for each rupee of sale. The earning capacity of the business can be ascertained by taking the margin between cost of goods and sales. The higher the ratio, the greater will be margin, and management is always interested in high margin in order to cover operating expenses and sufficient return to the proprietor's fund. And calculation for the gross profit ratio, the formula is gross profit divided by net sales into 100. The gross profit is ascertained deducting the cost of goods sold out of the net sales. So we can understand this gross profit ratio better with an example. Here in example, net sales is 4 lakh rupees and cost of goods sold is 3 lakh rupees. And net profit is 30,000 rupees, and they are asked to calculate the gross profit ratio. And for the calculation of gross profit ratio, the formula is gross profit divided by net sales and multiplied with the 100. Here in the example, gross profit figure is not given. The net sales figure 4 lakh rupees is given, and cost of goods sold 3 lakh rupees is given. The cost of goods sold 3 lakh, when it is deducted out of the net sales of rupees 4 lakh rupees, the gross profit is 1 lakh rupees. This gross profit 1 lakh is divided by the net sales 4 lakh rupees and multiplied with the 100. The answer is 25%. The 25% gross profit ratio indicates that for every 100 rupees sales of the firm, 25% is the gross profit. The next profitability ratio is net profit ratio. This is the ratio of net profit to net sales and is also expressed as a percentage. Net profit refers to the excess of total sales over the total expenses for a given accounting period. This ratio indicates the amount of sales left for shareholders after all costs and expenses have been met. The higher the ratio indicates management's ability to operate the business with sufficient success in covering all operating and non-operating expenses, leaving some amount of profit as compensation to the owners who have provided funds to the business at a risk. This ratio reflects the overall efficiency of the firm, and it is calculated net profit divided by net sales into 100. Let us see the example to understand the net profit ratio. Here is an example. The gross profit margin of a company is 12 lakh rupees and the operating expenses are 4 lakh 50,000. The taxes to be paid are 4 lakh 80,000 rupees. The sales for the year 27 lakh rupees, and the net profit ratio is net profit divided by net sales into 100. Here in this problem, the net profit figure is not given, but we can ascertain this net profit by deducting the operating expenses and taxes out of the gross profit. The gross profit is 12 lakh rupees and expenses 4 lakh 50,000 and taxes 4 lakh 80,000 deducted, and the net profit is 2 lakh 70,000. This net profit 2 lakh 70,000 divided by the sales of rupees 27 lakh and multiplied with the 100, the answer is 10%. It indicates that in this firm the net profit margin is 10%. You can understand like this also. For every 100 rupees of sales, the firm earns 10% as net profit. Let us see the another profitability ratio, that is operating profit ratio. It is a modified version of net profit to net sales ratio. This ratio establishes relationship between operating profit and sales. The formula for calculating operating profit ratio is operating profit divided by net sales into 100. And what is operating profit? A profit from business operations before deduction of interest and taxes or income from core business activities or trading activities refers as operating profit. It is important to understand what expenses are included and excluded when calculating operating profit. It typically excludes interest expenses, non-recurring items such as accounting adjustments, legal judgments, or other one-time transactions, and other income statement items not directly related to company's core business operations. Here the operating profit is ascertained taking net profit and adding non-operating expenses minus non-operating incomes. Here the examples of non-operating expenses are given: goodwill, patent right, copyright, trademark written off, preliminary expenses written off, discount on issue of shares and debentures written off, interest on debentures, underwriting commission, loss on sale of fixed assets, gift given, damages paid under legal suits, transfer to reserves, depreciation, premium payable on redemption of shares and debentures, dividend paid, provision for tax, and tax paid. These are the examples of non-trading expenses which need to add to the net profit. The examples of non-operating incomes are appreciation of fixed asset, profit on sale of assets, profit on revaluation of fixed assets, dividend paid, refund of income tax, gift received, income from investment, rent received or outstanding. These are the non-operating incomes we have to deduct after adding the net profit and non-operating expenses. Higher operating ratio is preferred as it indicates internal profit generating capacity of the firm. Let us understand calculation of operating profit with an example. Opening stock, closing stock, purchases, sales, manufacturing expenses, administration expenses, interest on debentures and net profit informations are given. Here manufacturing and administration expenses are operating expenses and interest on debenture is non-operating expenses. The formula for operating profit ratio is operating profit divided by sales into 100, and operating profit is ascertained taking net profit. Net profit is 5,000 rupees and adding one non-operating expenses as it is given in the example, that is 1,000 rupees interest on debentures, and the operating profit is 6,000, and operating profit 6,000 divided by sales 36,000 rupees as it is given in the problem and multiplied with the 100, the answer is 16.7%. It means that for every 100 rupees of sales, operating profit of the firm is 16.70%. And the fourth profitability ratio is operating ratio. This operating ratio is also called operating cost ratio. This ratio establishes relationship between operating cost and sales. This ratio measures operational efficiency of business enterprise by providing an idea about cost structure of the concern. And the operating cost ratio is calculated with the formula operating cost divided by net sales into 100. What is operating cost? It refers to the expenses associated with the maintenance and administration of a business on a daily basis. It is also known as operational cost. It includes operating and overhead expenses as well as the cost of goods sold. And the operating cost is ascertained cost of goods sold plus operating expenses like factory cost, administrative cost, sales and distribution expenses. A low operating ratio is an indication of efficiency of the business. A high operating ratio is an indication of the operating inefficiency of the business. Let us see the examples to understand operating ratio. From the following particulars, calculate operating ratio. The sales is given 5 lakh rupees, opening stock, purchase, manufacturing expenses, closing stock, selling expenses and office expenses are provided. They are asking to calculate operating ratio. The formula for operating ratio is operating cost divided by net sales into 100. So here how to ascertain this operating cost. Operating cost is equal to cost of goods sold plus operating expenses. So first we will ascertain cost of goods sold. The cost of goods sold is ascertained taking opening stock 1 lakh rupees and purchase 2 lakh rupees plus manufacturing expenses 25,000 rupees and deducting closing stock 30,000 rupees. The cost of goods sold is 2,95,000 rupees. And the other operating expenses which is given in the examples are selling expenses and office expenses, and the total of these operating expenses is 25,000 rupees. Operating cost is 3,20,000 rupees, taking cost of goods sold 2,95,000 and adding 25,000 operating cost. and operating cost is 3,20,000 is divided by the net sales as it is given in the problem 5 lakh rupees and multiplied with the 100, the answer is 64%. It means for every 100 rupees of sales, 64% involves operating cost of the firm. When operating cost ratio is calculated, it becomes very easy to calculate operating profit ratio. 100 is taken and minus operating ratio 64%. The answer is 36%. This 36% represents the firm's operating profit ratio. We can get the same answer by applying the operating profit ratio, operating profit divided by sales into 100. We don't know the operating profit. We can ascertain the operating profit deducting the operating cost out of the sales. Sales is 5 lakh rupees and operating cost is 3,20,000 rupees as we are calculated earlier. 5 lakh minus 3,20,000, operating profit is 1,80,000 rupees. 1,80,000 operating profit divided by sales 5 lakh rupees multiplied with 100, we got the same answer 36%. Let us see the expenses ratio which are associated with the sales. These ratios present the relationship that exists between each item or group of expenses to the net sales. It indicates the portion of the sales which is consumed by the various items of operating cost. The formula for calculating material cost ratio is direct material cost divided by net sales into 100. This ratio expresses the percentage of direct materials cost included in the net sales. Labor cost ratio, the formula is direct labor cost divided by net sales into 100. This ratio expresses the percentage of direct labor cost included in the net sales. Like factory cost ratio, factory overhead cost divided by net sales into 100 is the ratio. It expresses the percentage of factory overhead cost included in the net sales. The another expenses ratio is administrative overhead ratio. Administrative overhead divided by net sales into 100. It also expresses the percentage of administration overhead absorbed in net sales. The last expenses ratio is selling expenses ratio. The formula is selling expenses divided by net sales into 100. It indicates that the percentage of selling expenses included in net sales. All these expenses ratios are preferred at low because it indicates management's better efficiency in controlling expenses. Let us understand various profitability ratios with an example. Here notes to accounts of statement of profit and loss is provided, which consists of sales 5 lakh rupees, interest on securities, dividend on shares, profit on sale of shares. These three are non-operating incomes. Here the cost of material consumed is given, opening stock of raw materials, add purchase of raw materials, less closing stock of raw materials. The total cost of material consumed is 2,93,000. Wages 5,000 rupees, financial expenses 7,000 rupees. This is another non-operating expenses. Carriage, administrative expenses, selling and distribution expenses. These are the operating expenses. And loss on sale of fixed asset, provision for legal suit. These two are the non-operating expenses. The net profit is given 84,000 rupees and they are asked to calculate various ratios. Let us see the first one, gross profit ratio. The formula for gross profit ratio is gross profit divided by net sales into 100. Here in the information, gross profit is not given. We have to calculate the gross profit. The formula for gross profit sales minus cost of goods sold. We need to calculate first cost of goods sold here. The cost of materials consumed plus wages plus carriage. So cost of materials consumed plus these two operating expenses, the total 3 lakh rupees represents cost of goods sold. When cost of goods sold 3 lakh rupees is deducted out of the sales 5 lakh rupees, the answer of gross profit is 2 lakh rupees. 2 lakh divided by net sales of 5 lakh rupees and multiplied with 100, the answer is 40%. The firm's gross profit ratio is 40%. See the another calculation of net profit ratio. The formula for calculating net profit ratio is net profit divided by net sales into 100. As net profit is given directly in this problem, 84,000 rupees and sales is also given 5 lakh rupees. 84,000 divided by 5 lakh rupees and multiplied with the 100. The answer of net profit ratio is 16.80%. The third one is calculation of operating profit ratio. The formula is operating profit divided by net sales into 100. So here operating profit is ascertained taking net profit 84,000 rupees first and adding non-operating expenses of loss on sale of fixed asset and provision for legal suit. These two expenses are added and deducting the three non-operating incomes like interest on securities, dividend on shares, profit on sale of shares. These three non-operating incomes are deducted and the operating profit is 80,000 rupees. 80,000 rupees divided by net sales 5 lakh rupees multiplied with the 100, answer is 16%. The firm's operating profit ratio is 16%. The fourth calculation is calculation of operating cost ratio. The formula is operating cost divided by net sales into 100. Here the operating cost is ascertained cost of materials consumed plus wages plus carriage. These things represent the cost of goods sold, and added operating expenses like administrative, selling and distribution expenses. The total operating cost is 4,13,000 rupees. 4,13,000 operating cost divided by 5 lakh rupees net sales and multiplied with the 100, the answer is 82.6%. And the fifth one is calculation of administrative expenses ratio. The formula is administration overhead divided by net sales. Here administration expenses given 1,01,000 rupees and divided by sales 5 lakh rupees and multiplied with 100. The answer of administrative expenses ratio is 20.20%. The sixth, calculation of financial expenses ratio. The financial expenses divided by net sales is the formula and multiplied with the 100. Financial expenses is given in this problem is 7,000 rupees and net sales is 5 lakh rupees and multiplied with the 100. The answer of financial expenses ratio is 1.40%. The seventh one, calculation of selling and distribution ratio. The formula for selling and distribution expenses divided by net sales into 100. Selling and distribution expenses amount is 12,000 rupees and divided by net sales of 5 lakh rupees and multiplied with 100. The answer is 2.4%. Eighth one is calculation of non-operating expenses ratio. The formula is non-operating expenses divided by net sales into 100. The non-operating expenses are these two: loss on sale of fixed asset and provision for legal suits, and the total of these two items are 2,000 rupees and divided by net sales 5 lakh rupees and multiplied with 100. The answer is 0.40%. It means the non-operating expenses of the firm is 0.40% of the sales. And the ninth and last one is calculation of non-operating incomes ratio. The formula is non-operating incomes divided by net sales into 100. The non-operating incomes are three: interest on securities, dividend on shares and profit on sale of shares. These three items total is 6,000 and divided by net sales and multiplied with 100. The answer is 1.2% of the sales. It means non-operating incomes are 1.2% of the sales. Dear friends, thank you very much for watching this video, and I hope that this profitability ratios in relation to the sales video is helped you a lot. And in the next coming video, we are going to discuss the profitability ratios in relation to capital and investment. Till then, take care.